Hello, everybody. My name is Michael Duke, and welcome to my show where I analyze stocks that are interesting. So, if you find that interesting, please consider liking this video and subscribing to the channel so you see more. Very interesting company that we're going to cover today, Clearway Energy Inc., ticker CWEN.A. Those are, of course, the Class A shares. There are also publicly traded Class C shares under the ticker CWEN. Clearway is a renewable energy utility-esque company or a yieldco that owns renewable energy assets such as wind farms, solar turbines, and a small amount of natural gas production. As usual, I'm going to give some background on the company. I'm going to take a look at the financials. I'm going to discuss the sentiment and some of the trading behavior. We're going to take a look at the valuation. We're also going to do some technical analysis, take a look at the dividend metrics and technical analysis. Did I say that already? And as always, I'm going to give it a grade: buy, sell, or hold. Full disclosure, I do have the Class A shares in my portfolio. So without further ado, let's get into it. First things first, company is performing very strongly year to date, up 12.31% versus the S&P 500 barely eking out a positive return. Very, very good performance. But what's driving that? Well, we'll take a look. But first, I want to discuss what the company is in the first place and how it was created. So, the genesis of the company comes from another utility called NRG Energy. Those based in Texas might be familiar. NRG is HQ'd in Houston, Texas. And in February 2018, they announced that they were going to sell their stake in Energy Yield, which is was a yieldco or a tax advantage renewable energy investment pass-through vehicle to Global Energy Infrastructure Partners. We'll come back to that in a second. In August, the company changed its name to Clearway Energy, began trading under the new name and ticker symbol CWEN and CWEN.A as it remains today. This here is the corporate structure of the company, and why this is relevant is because there are four classes of common stock: A, B, C, and D. The B and D classes have a majority of the voting rights for the company, whereas the A and C shares have a minority 45.1% voting interest. In fact, all of that voting interest is in the Class A shares, are CWEN.A. Why that's relevant is that the 50-50 split, the 50-50 ownership of Clearway Energy Group LLC is between GIP and Total Energies, of which Clearway Energy Group has 100% of these B and D shares. So, in other words, these two entities effectively control the majority of the voting rights, whereas the public shareholders in the Class A and Class C shares have a majority of the economic interests in the company, totaling 58.29%. There is no difference in economic rights between Class A and Class C, only voting rights. That's a pretty complicated way to say that the company essentially exists to pay safe and growing dividends to the common shareholders. However, it is controlled 50-50 more or less by these two entities. Total Energies is a European utility company, and Global Infrastructure Partners was recently sold to none other than BlackRock for $12 billion. That was actually recently completed. So BlackRock and Total Energies have operational control of the company, whereas Class A shareholders have 45% control of the company, but a majority of the economic interests. All right. So let's get into what the company operates. This here from their website is the portfolio of operating capacity. Very interesting. So, in terms of solar, we have 4,070 megawatts total, of which the company has ownership over 2,500 megawatts. Wind, the gross capacity being 4,300, of which the company owns 3,800. And then there's this paired storage portfolio here, of which the company has ownership of 256 megawatts out of the 688 gross megawatts. And then this flexible generation here, 2,600 net megawatts. So quite a bit. You see the offtake counterparties here. That is the customer engaged in the long-term purchase agreement. For the energy, you have PG&E, Tucson Electric, Southern California Edison, Hawaiian Electric, Verizon, you name it. Even Nebraska Public Power, Pacificorp, Citigroup, Maryland Department of General Services, University System, so on and so forth. I urge my viewers, if you are interested, to carefully review the information contained on this website. It's very comprehensive and very interesting. The largest category is wind power, followed by flexible generation, followed by solar, and last but not least, the paired storage. Okay, so recently, this is a press release dated April 30th here. Press release of their first quarter financial results. Today reported first quarter 2025 financial results, including net loss of $104 million, or because it is a yieldco, because it has a significant of tangible assets. In fact, that is basically what it owns. It owns the power generation assets, capital heavy, turbines, solar farms, the battery storage, you name it, that's capital intensive. Those are real assets. So the company can depreciate significant amounts against that, which means that on paper, that it is not surprising that they would lose money. But we see that EBITDA, so earnings before interest, tax, depreciation, amortization, 252 million. And this is the important part right here. Cash available for distribution of 77 million. Cash available for distribution is something that we see typically in a master limited partnership type structure. And given that this is a yieldco, it is very similar to a master limited partnership, but without the technicality and tax complexity. So we see here that their paper loss for the 3 months ended, or the quarter ended in March versus the prior year, significantly higher. However, adjusted EBITDA up 41 million. That's roughly 20%. That's really good. And then we also see that 77 million of cash available for distribution, 77 million versus 52. So that's almost 50% for the prior year quarter. That's pretty good, right? Okay, we see here flexible generation equivalent availability factor. That's quite the mouthful to say, but that basically means the availability, as far as I understand, the availability of the capacity of those assets utilized. In other words, we know that renewable energy sources are not always maxed out. In fact, they're almost never maxed out to their max capacity. Therefore, they have a equivalent availability factor less than 1. And we see that here. However, it was better versus the prior year quarter. And we see across the board, this is in megawatt hours. We had 4,000 megawatt hours prior, or excuse me, 4 billion. We had 4 million up to 4.5 million. So greater than 10% growth, double digit growth. They're very good. They do break out this liquidity piece, which is important because not only do they need liquidity to pay the dividends, they need liquidity to pay the pretty high debt burden that they have, which we'll take a look at in a moment, and be able to fund acquisitions. So we see here that they essentially had 300 million of non-restricted cash, but there were 166 plus 248 restricted. So they actually break out their reserves here, and that includes what they're distributing. So 700 million of cash, and they have 600 million on a revolver. So 1.3 billion of liquidity there, not bad. Here they discuss some of the investments that they made. So we'll just, we won't focus on this too much, but we'll just briefly review. On April 25th, that was 3 weeks ago, company entered into a binding agreement to acquire approximately 100 megawatt operating solar project located in California from a third party. The company expects its corporate capital commitment to acquire the facility between 120 and 125 million. Project reached commercial operations in 2013, has a revenue contract with an investment grade utility through 2038. On April 29th, 2025, the company closed the acquisition of Tuolumne, a wind project, 137 megawatt wind project located in Klickitat County, Washington, from the Turlock Irrigation District. The project has a power purchase agreement with Turlock Irrigation District, an investment grade regulated entity with an initial contract term of 15 years to 2040. The commitment there is $61 million. They expect the project to contribute cash flow available for distribution on a 5-year average basis, annual basis of approximately $9 million. Not bad. When we look at here, we have 77 million. That's just over 300 million on a annualized basis. So that's again, it's up and down each quarter due to the seasonality of renewable energy assets. However, that's roughly 3 points of bottom line growth to shareholders. Very important from that one acquisition. So that's pretty cool. Mount Storm Repowering. February 12th, the company entered into agreements with Clearway Group to repower the Mount Storm Wind Project located in Grant County, West Virginia. Upon achieving repowering commercial operations in 2026 and 2027, the project is expected to sell power to Microsoft for 20 years under an awarded power purchase agreement. The company will have the option to invest approximately 220 to 230 million in long-term corporate capital, subject to closing adjustments, estimated to contribute cash flow available for distribution on a 5-year average annual basis of approximately 26 to 28 million beginning in 2028. We got a 20-year deal with Microsoft, and that is close to a double digit from the current run rate of CAFD. Then we have a couple of potential repowerings. Okay. Clearway Energy, the board of directors declared a quarterly dividend of 43.84 cents per share. We have the X date for that coming up here in about 2.5 weeks. Just a few things to note on the balance sheet. Derivative instrument. They do hold over 100 million of derivatives as they are hedging the power price, and they're also hedging interest rate risks due to the meaningful amount of debt that they have. You see here 392 million of current long-term debt and 7.2 billion of long-term debt. So we see this is in the 10Q here. I'll go to the 10Q. They break down their debt. Here is a description here of they're basically saying for our derivative contracts here, what the significant unobservable inputs used in developing fair value. So they have energy-related commodity contracts in the form of, what they're hedging is forward market price power, forward market price gas, and forecast generation levels. It appears to hedge their risk. We've got $2 billion maturing between 2028 and 2032, excuse me, with 3.75 to 4.75 interest that is fixed. And then we have non-recourse facility level debt. So these are project level or subsidiary entities holding assets. Those entities have project level debt that is non-recourse to the corporate entity. So think about that like an SPE that holds a big commercial building, or something in the like that has a mortgage or some sort of revolver. The debt is associated with the asset. So while it is easy to look at their financial statements and feel that they are burdened with a lot of debt, their financials do not look too different from a REIT. They're kind of like a REIT, right? And I think that's how we need to look at this. It's very similar to real estate, but instead of having tenants, we have long-term power purchase agreements. There probably is, and reasonably so, some pricing exposure that fluctuates. Otherwise, they wouldn't feel the need to hedge with derivatives. However, some of that might be fixed rate as well. So very, very interesting capital structure, corporate structure. So let's just discuss the valuation. Again, if you are here on Seeking Alpha and you try to make sense of the financials utilizing what's provided to you here, it might be confusing given the way that the company is organized. For example, they're paying out $1.75 in dividends, but only earning 31 cents a share. Again, remember, there's significant amount of depreciation. So the cash flow available for distribution is what is relevant there. And we see here that they're targeting all the way out several years in advance. They're giving guidance. They're targeting 2027 to have $2.60 per share cash flow available to distribution versus that current distribution that gives you an idea of the underlying economics. So this price earnings ratio here, not super relevant. Not super relevant, right? We have a $6 billion market cap, a shade under that. But if we go our cash, I'm just going to back into our cash available for distribution. Let's see if they do that for us or if I have to calculate it manually. Again, we know the 77 million. Here's their full year guidance, by the way, 400 to 440 million of cash available for distribution. Yeah, so I'm gonna have to back into this. Just bear with me here. I'm getting my calculator set up. How many shares do we have? Okay, so common stock, there are 3 billion shares, right? And I assume that our cash available for distribution is solely intended for the common shares. But if I divide 77 million divided by 3 billion, I'm doing that wrong. What am I screwing up here? Maybe if I look at this, it'll give me a better idea. Okay, so here I'm not converting for the proper. Here we go. That makes sense. So that's how we get to our 118 million share. So 77 million divided by 118 million is 65 cents. 65 cents per share of CAFD. That was quite the goose chase. Okay. So I took this number here, 77 million, and I divided by that number of class right here, weighted average number of common shares outstanding, basic and diluted. So the reason my initial calculation was wrong is because I wasn't converting par value and I was including the other shares there, which it appears that the cash, they're quoting everything based on the A and C units. So 65 cents per share of cash available for distribution, of which dividends paid in that last quarter, 43.12 cents. And they declared a dividend right here of 43.84. So our payout ratio was roughly 67% in that quarter. What we were doing there was, again, we were 6525. In fact, this number here, we were calculating the valuation. So our cash available for distribution on the quarter annualized, 261 per share. That's close. That means that the current valuation a little bit more than 10 times. Furthermore, what they are arriving to here is their guiding. Where is their guidance? They're guiding. This is probably giving everybody watching this a seizure right now. So 400 to 440 million of cash available for distribution. So let's just assume the low end there. 400 million, right? Divided by our 118 million of shares. 338 or 339 of CAFD per share on a forward basis, divided by 27.41. 27.41 divided by 3.39. So that would basically mean that given their guidance on the low end, it's trading at an 8 times multiple on the cash available for distribution. So from that standpoint, I believe that the valuation is pretty good. Again, we're looking at a business that the only moat that it has is the fact that it owns the assets. The assets are somewhat commoditized. The location is somewhat relevant given its proximity to the utility and connection to the grid and the price of what they're able to agree to with the utility. But it's fair to say that a yieldco does not have an economic moat and does not really have strong pricing power. So I think an 8 times forward valuation on a business like that, which is effectively a 12% cash available for distribution yield, is pretty decent, pretty lucrative forward valuation for us to invest in potentially. You'll notice here that all of these valuations here are fairly meaningless, with the exception of these yield-based numbers here. So it does screen out to an A minus. However, you really got to drill in and do your own calculations when valuing the company. Okay, so just something to be aware of. So let's talk about the dividend now, because I think this is a pretty compelling aspect. Again, given that it's a yield co, it exists to distribute cash flow and grow, but exists to distribute cash flow. And I think that that's super relevant. So based on this, again, we're kind of tracking here. I said roughly a 12% cash available for distribution. Conceivable to think that the free cash flow is going to be different than that, right? But that largely tracks there. The current yield that the shares are trading at, just over a 6%. Now, at one point in time within the last year, you could have purchased the shares at 8-ish%, but you see how it's been hovering between the 6 and 8% range. At one point, it was much more meaningfully valued, but with interest rates being higher, the stock price has suffered somewhat because it is kind of like a bond proxy with some modest growth. So you see here, our starting yield is 6.15%. That's pretty good. It's meaningfully more than the 10-year treasury. But the real kicker here is that in every quarter since the quarter ending, or since the August 2020 quarter, the distribution has increased. They've increased the distribution every single quarter. And the rate at which they've done that is pretty good. We see here that in over the last 12, they've increased by 7.25%. a 15.74% CAGR over 5 years, 7.5% over that time frame. Very, very strong dividend growth. And in fact, if we look at their commentary here, they increased the quarterly dividend by 1.7% here. So if you were to increase your payout by 1.7% every quarter, that would equate to a roughly 8% payout increase over a year. While it's conceivable to think and healthy for the company to not increase it quite as much as they're growing underneath so that they can compound quicker, I think when we look at a dividend that is starting at 6% today and growing, 6, 7, 8% into the future, I look at that cash flow stream as one that will essentially be spitting off a double-digit return for the foreseeable future. So very, very strong return potential in that distribution. So there's a lot to like. There's a lot to like about that, and it's all about the sustainability of it. So how are they able to generate such strong growth? Well, just by they're benefiting from the tailwind of renewable energy right now, which I have a lot of traditional energy in the portfolio between Energy Transfer LP, MPLX LP, Alliance Resource Partners. I've done videos about MPLX and Alliance Resource Partners. And then I also have some Dalek Logistics Partners as well. Apologies if I'm not pronouncing that correctly. But all of that is pipeline, more traditional oil gas type stuff. So looked at through that lens, renewable energy is kind of the antithesis of that. It's the same idea, but a different source, a different cycle. So the company is benefiting from the tailwind of more investment in renewable energy. Your customers are the utilities. Utilities have an incentive and need and demand to source more of their energy from renewable sources because that's a sexy thing to do. Therefore, they turn to a company like Clearway Energy to help them do that. So I see the outlook being very strong for this company in the intermediate term, where there's willing buyers for what they sell in the marketplace. Now, if we turn over to the shares, I'm just going to compare, and this is relevant for me. I urge my viewers out there to, if you do have energy investments, I urge you to perform a similar analysis here on your own portfolio. Okay, let's get rid of the S&P. Let's get rid of this one too. Okay, so Clearway is the orange. Energy Transfer is the purple. So I'll tell you what I notice about this is here Clearway from this period to this period kind of saw this broad-based dip and recovery here really over this 9 months here, right? And Energy Transfer kind of had the opposite momentum. It kind of traded up and then down throughout that period. Now, here being Liberation Day, all of the assets sold off, and they do appear to be more correlated really over the last 6 weeks. But really, what I'm trying to illustrate here is that while it isn't really a strong negative or inverse correlation to these other more traditional energy companies, it has demonstrated somewhat of an inverse trading pattern to a few of them. If we look at this on a year-to-date basis, we actually see that while all of these companies have performed very well year-to-date, with the exception of Energy Transfer, Clearway is the best performing asset out of these 4 assets here. So very, very interesting, right? The picture I'm trying to paint there is that it's been a strong performer, and it is somewhat the antithesis to oil and gas. If you have a significant amount of your portfolio in traditional oil and gas and coal like I do, then it does make sense to perhaps allocate some capital to renewable energy, because over the long term, those assets should be correlated to each other. And this business is much different in a lot of ways than energy transfer, for example. However, the correlation with commodity prices and the cycles and all that, I believe that this asset provides a good amount of diversification, both cash flow wise and trading behavior wise, versus some of the other stocks that I have. Although it's not very clear cut. Okay, so let's take a look at the chart. So you see here when it IPO'd, it immediately sold off by like 60 to 70% within 6 months. But really, since that time, it has been trending up. Here's our long-term trend. Now, one thing to note here is, again, I don't know if it's probably a chart crime for me to use this point here as a frame of reference, but the market certainly did. Here, interest rates were exceptionally low, right? And this company benefited from that, of course. So the price really got ahead of itself. Of course, we were looking at the yield. We were looking at the yield um, metrics, right? The dividend yield. The price really got overheated in this channel here and got away from itself. But when interest rates went up and stayed up as they are now, we kind of backed off. We backed off here on the stock price from that channel, and now we're kind of back in this like more plodding and reasonable level of growth here. So I almost want to ignore this part right here. I almost want to ignore that and just consider the trend line to really be within these two lines here. Now from that, we actually have a pretty bullish looking formation, because we've had this a little bit more steep line here that we're trading in. And what's going on is we've been, again, ignoring this part of the trading history here. We've been making higher highs and higher lows, but kind of consolidating towards this event horizon here. So while we are, if we look at this line and this line here, while we are towards the high end of that, and it's conceivable to think that there's, if we're going from a purely technical perspective, that there's, risk to the downside rather than the up. Things are more important than just the technical. But really, we've continued to trade between this line and this line within the last 6 months, of which eventually we will resolve here. And there's one of two ways that can go. Again, assuming that this is your technical analysis, we either go above that or we go below it, in which case the long-term trend line would still, be intact in that case, or we break out to new all-time highs here. So ultimately, while we are nowhere near the all-time high price of these shares, we are, as we calculated, at what I believe to be a very reasonable valuation and a really juicy cash flow for something that really is benefiting from tailwinds here. So I think, technically speaking, I see no heartburn around continuing to accumulate shares within this range. However, if we get up closer to the 30 level here, without a breakout, that might be a little bit more tenuous, at least in the short term. But I think definitely, if we're hugging either this line here, that does appear to be a very appropriate place to accumulate. And in fact, the Seeking Alpha Quant has a buy rating, and we know that the Quant rating is really a retroactive looking momentum indicator, and it also looks at the financials. So the Quant rating gives us a buy. And I have to agree with that. Just from a technical perspective, I think the chart is fairly bullish looking, and one must appreciate that this era here was a debt fueled bubble, of which we are no longer in, thankfully. So let's talk about the risk. Well, I think the main risk here is, again, shareholders don't have operational control. That's not necessarily a bad thing. This company is never it's never going to be a crazy compounder of your capital. It will compound your income if it continues on the trajectory that it's been on, which I fits my strategy very well. However, it's not a compounder per se. So because of the way that it's organized, it is sensitive to interest rates. If interest rates go up a lot, that could put downward pressure on the price. However, the yields on those acquisitions, the yields on the acquisitions there that the company is making are, 10 to 12%, maybe even a slightly higher. So low double digit uh, cash flow available for distribution yields on these new assets that have 15 to 20-year durations. Um, Even if interest rates go up 200 to 300 basis points, the underlying economics of these projects are still very, very sound at those yields. And conceivably, they might be able to get them for even higher yields. So while I do believe that the share price will be sensitive to interest rates, I do think that the underlying economics of the company, while they might be more challenged as if interest rates go up, which I think there is moderate risk that it continues to occur, that interest rates go up. I do believe that we're going to be good here, at least in the intermediate term. So really, the fact that this will be it's essentially a bond proxy with some growth, with very strong growth. I think we have to appreciate that. I think another thing we have to consider is the cost, the depreciation, the capital needs of the assets in the long term. Um, do become an issue for the company to continue to fix them up. It's a little bit more capital intensive than real estate, with better unit economics, I think. So that's just another thing to consider. So just to summarize that, the main risks are the corporate structure, which I find very benign. You have the interest rate risk, and then you also have the kind of long term underlying, like, capital intensive asset risk that occurs. However, we can't, it's not super easy to quantify that given our position and the information we have available. So I think that that's more of a thing that is monitored over time. But ultimately, I still think, even with the confluence of all those factors, that it still looks attractive. And in fact, the existence of all those factors, this thing is never going to trade at 20 times earnings. I mean, maybe, or 20 times cash available for distribution. Arguably, it might have up in this range, but we're certainly not close to that here. So I think we have a really, really strong outlook. So I'm going to agree with the quant here and continue to mark this one as a buy. Now, of course, this is not financial advice. Please consider your own portfolio objectives here. If you're looking to invest primarily for growth, this probably is not for you. My portfolio is income focused. Therefore, this is an attractive asset for me, and I think it might be an attractive asset to all folks out there who are looking to generate steady and growing income in their portfolios, particularly income greater than bonds. Safe bonds, really. There is a risk premium here that is adequate. We're 150, 200 basis points above treasury yields here. Also, potentially growing by 6 to 8%, at least for the next few years. I think that that's a very, very strong valuation, and very, very fair. So I think that that's just a very attractive valuation. However, again, there's a reason that it's cheap, it's not something that's going to accrete an enormous level of enterprise value over time through multiple expansion. So just know what you're getting into if you're considering an investment in the company. Um, Hopefully that covers everything that is relevant. I've certainly had a good time with this video today. Hopefully you have as well. Leave me a comment with your thoughts below. Good time for me to mention that all my viewers get access to a discount on the Seeking Alpha Pro subscription. That will be linked in the description. So be sure to check that out if you're interested in utilizing Seeking Alpha. You can get access to all the information contained within here, as well as read my articles that I upload here. I don't have an article on this one, although I plan to write one on this one. But yeah, I think this is an attractive prospect for income-oriented portfolios, particularly for income-oriented portfolios with a heavy emphasis on energy investing, of which is mine. So, of course, my views are biased and you should take them with a grain of salt. And as always, you should do your own research. But hopefully, my research is helpful and informative for your own portfolios and goals. And you found this useful and entertaining. With that, that's going to conclude our video today. As always, it's a pleasure doing these breakdowns for you. If you've enjoyed the video, just consider hitting the like button and subscribing to the channel so you see more of these, what I believe, undercovered gems to be analyzed. Anyways, that's going to be it. Thank you for watching and have a good rest of your day. I will talk to you soon with my next piece of work. All right, bye.